Hi, I'm Jacqueline Jackson, Senior Portfolio Manager at the Center. Thanks for clicking on our quarterly investment commentary. We will start our normal market update featuring Partner and Director of Investments, Angela Palacios. Angela will be discussing the top 10 themes our investment committee is navigating this year. Speaking of which, we know this has been a trying year for investors, so we have a special offering this quarter. In addition to our normal commentary, we have an on-demand Q&A webinar featuring our investment team that focuses on your most asked questions so far this year. To access this special webinar, enter your email address below, and the webinar will be immediately sent to you. Addressing your questions is very important to us, and we hope this additional resource is helpful. So with that, I'll turn it over to Angela.
The first half of 2022 has been a volatile one, as I'm sure you know. The S&P 500 logged its worst first half of the year in over 50 years. While we've seen many of these economic and geopolitical factors alone in isolation before, it's the unique combination of these factors that have made market volatility, interest rates, and inflation hard to predict. During these uncertain times, I want to highlight 10 different themes that we're thinking about right now and how they might impact your investments. The first theme is there's a rising risk of recession here in the US. While no one has officially called that yet, it's looking more likely that we could enter one later this year or in 2023. 2 quarters of negative GDP, gross domestic product, 1 quarter of which has already been logged in the first quarter, is the traditional definition of a recession. The amount of Google searches for the word recession are even nearing 2008-2009 levels, so I know many of you are worried about that. The second theme is inflation. Inflation has been much more persistent than anticipated this year. Early indicators continue to support that we're starting to see it come down. But what if inflation continues to persist? You still have to own stocks, and that's really your best chance to outpace inflation. Emerging market equities might surprise you that they've historically been good performers during periods of high and rising inflation, as well as high and falling inflation. Gold has helped during recent surprise inflation, but not as much as many investors had hoped it would. While gold and precious metals tend to help in the early inflation surprises, they tend to be a little bit less helpful to offset inflation over the long term. The third theme is interest rates. In June, the Federal Reserve raised rates by 0.75% because inflation came in higher than expected. This was the third rate increase this year so far, and the Fed has shown that they're going to aggressively fight inflation with interest rates. If inflation continues to print higher, they will continue to raise rates more. It's no mystery, that it's been a tough year for bonds this year. It's likely that the worst is over, as there are some pretty hefty rate increases built into the bond market pricing and yields right now. But we have added shorter duration bonds over a year ago to portfolios to help during market drawdowns like we've experienced. We continue to hold that position, but we are monitoring trimming back on that at some point as rates start to normalize. Theme 4 is geopolitical conflicts. The Russia-Ukraine conflict sadly still continues with no resolution in sight. While these headlines aren't directly impacting day-to-day market moves anymore, their repercussions from sanctions on Russia continue to impact other macroeconomic factors like rising energy prices, which has a direct impact on inflation. The fifth theme is midterm elections. As we look at the midterm elections in November, it does look like the blue wave of Democratic control is on thin ice. The lower the president's approval rating going into midterm elections, usually the bigger the losses. And when President Biden's approval rating is around 42% and has held there pretty steadily all year, that is quite a bit lower than historical averages, so we might see more turnover there. I often get the question of, should politics influence our investment decisions? And the short answer is no. I don't think they should. If things end up tilting more toward the Republicans, this could be positive for stocks, as investors usually assume that equates to the potential of lower taxes, or at least not increasing taxes. But generally, it's not a good idea to let politics drive your investment decisions. Cryptocurrencies are another theme that we follow. Last year, experts were claiming that cryptocurrencies are the only true inflation hedge, and now fast forward to this year, cryptocurrencies have dropped more than 50% in the face of inflation. Speculation and volatility are and will continue to be a hallmark of this type of asset. Proceed with caution if you do so on your own, as this isn't an asset that we recommend holding as part of your long-term asset allocation. I often get the question, should we do something? Is it better to do nothing during times like this when markets are volatile? Investors often feel the need to do something when they're volatile. Our fight or flight instinct kicks in. That's been ingrained in our being for hundreds or thousands of years. If you are doing something, make sure it's the right thing, driven by the right reasons, as doing the wrong things can be very costly to your long-term financial success. Talk to us about that if you are feeling the need to do something, and we can help you with that decision. Theme number 8, we've got elevated oil prices and this year, and that can really reinvigorate interest in renewable energy. Energy has been by far and away the best performing sector in the market, the S&P 500. That doesn't mean it's going to be the best performing sector going forward. Usually, by the time something's making headlines, the returns have been booked. But as fossil fuel prices continue to rise, it makes alternative fuels more cost effective and can accelerate the adoption by our population in items like hybrid vehicles, perhaps, or electric vehicles. This may translate well for those investors focused on ESG strategies. Diversification is our next theme. Many people think diversification is meant to improve returns, but it would be useful to reframe this idea, I think. Diversification is meant to improve returns for the level of risk you're taking. Not only is portfolio diversification useful for people who have already met their investment goals, maybe they're retired, for investors still working toward financial goals, portfolio diversification can help produce more consistent returns, thereby increasing the prospects of reaching these goals. Portfolio diversification can also help mitigate risk. It can boost portfolio resiliency, and it can provide investors with the consistency necessary to set and meet financial goals. And lastly, many of you ask what we do during market downturns with the portfolio management. We have been very busy behind the scenes, if you haven't noticed on your statements, doing things like tax loss harvesting, rebalancing, Roth conversions, if that's a strategy you're employing, making sure cash needs are met. We are monitoring factors that may tell us when to lighten up on or add equities as well. While these factors are meant to trigger rarely, as there's a shift in information incoming from our broad set of parameters, there may be changes in our outlook and strategy as well.
Thanks for highlighting those major themes, Angela. So you may be wondering, how does what Angela mentioned impact my portfolio? Here are some key takeaways to put things into context. First, we are making the best of market volatility with a tax advantage strategy called tax loss harvesting. Second, we are rebalancing to purchase inexpensive asset classes for long-term investors. Third, our research and back-tested process indicates we need to remain short for bonds in client portfolios. And only where it makes sense, specifically based on investment timelines and retirement goals, we are taking some risk off the table with U.S. stocks in lieu of the Fed intentionally and temporarily slowing down the U.S. economy. The fourth thing is, for long-term investors, we maintain high conviction in mitigating risk through portfolio diversification, which includes not giving up on equities and bonds in portfolios. Please keep in mind, we always are making sure clients have adequate cash in their portfolios to support their living needs. And we are always mindful of risk factors in your portfolio so you don't have to. We actively manage your portfolio so that your retirement goals are not compromised by market volatility. If you're interested in hearing more, I encourage you to watch our on-demand webinar. Again, to access the webinar, enter your email address below and the webinar will be immediately sent to you. As always, feel free to reach out with any additional questions. We're happy to help. Until next time, enjoy your summer.